Hey, what's up, Market Moose? Mike from the Moose on the Loose. Welcome to this Thursday chat with Nelson. Today, we thought about doing kind of like a segue with the energy show that we did 2 weeks ago, where we're not big fans of energy. And then we were talking about which kind of topic we wanted to tackle. And then Nelson said, well, I'm not a big fan of gold either. And I'm like, yeah, well, same here. However, we both own Franco Nevada. So we kind of like found a point of interest in talking about streamers, royalty earners across the energy and the basic materials sector. And I wanted to have your take on it, Nelson, first before we start talking about some specific companies and our love, our common love for Franco Nevada here. So, what do you think about that business model? That seems almost kind of like risk-free, right? You own the contract, you make the money, and then there you go. You don't have like any risks, so to speak.
Not a single risk. Yes, put that on your
Right.
disclaimer at the bottom of this. Absolutely no risks. From my perspective, I think that Mike, you talked about maybe the little bit of the positives there when it comes to this business model, where you're investing in the commodity without really investing in the commodity. So essentially, it's a financial transaction. It is a you pay the company pays X amount of dollars, and in exchange, they get to buy a certain amount of production for a certain amount of dollars. That's on the gold side. Oil, it's just the company pays per barrel extracted. So essentially, you have this financial contract that has a commodity kind of base to it. But from my perspective, I look at it, it's like it's a way to sort of get exposure to a certain commodity without taking all the risks of that commodity itself. So, in terms of gold, of course, gold has done very, very well lately, and people typically start to get excited about something after it's had this big run. And so I view it as, hey, it's a way to get some gold exposure that has a little bit less gold commodity price risk. There's still some risk in there. You'll see a relationship, but not a huge relationship. So essentially, that's what it is. It's a way to invest in the commodity without really investing in the commodity, or at least investing a little less in the commodity.
Yeah, and the interesting point here is, and the reason why we both dislike gold, I mean, personally anyway, is just the fact that if you have an ounce of gold, you put it on your desk, you wait for like freaking 20 years, and you still have the same ounce of gold. And I don't like to buy something that could just gain value because somebody else wants to buy it. But if no one wants to buy it, it has kind of like no value. And of course, gold has made the test of time. So I'm not arguing. It's a great way to protect against inflation because, I mean, 3,000 years ago, with an ounce of gold, you could like buy pretty much the same thing as today. So that kind of makes sense in that regard. But I love to buy companies generating cash flow to generate something. So they have like some kind of like control in their end. I wanted to start this episode talking a little bit more about the fact that it sounds like it's risk free. Like you said, you buy the contract, you get the money, but actually it's not. It's not like this. It's not perfect, and no business models are perfect. So I wanted to start talking a little bit with the oil and gas kind of like streamers that we can find, or companies that are based on royalty. I've identified two. So we're going to start with those, and then we're going to end the show talking about three companies that are a little bit more geared towards metals, mostly gold, but something else as well with Labrador iron ore. So one thing I want to highlight right here is Frehold Royalties, FRU. So this business has been around for a long while in, of course, the oil and gas business. So collecting those royalties. And it seemed like back in 2020, if you look at what happened back then, of course, they slashed their dividend and then it started to ramp up very quickly. But what I see now is now that the oil barrel is not moving that much. Actually, it's moving, but it's not going up anymore. So one week it goes up by $5. The next week it's going down by $5. So we're not going anywhere here. Well, the stock price has pretty much hover around that 13, $14. the revenue and the earnings are pretty much stable. And what I've seen here is, well, the dividend has gotten stuck at 9 cents since 23. No more increases while inflation keeps up. So it sounds like the business model is not completely oil and gas proof either. Like, what's your take on this one, Nelson?
Sure. So, Mike, you mentioned the 2020 dividend cut. I looked way back on Freehold a while ago, and there's actually been multiple dividend
Mm-hmm.
cuts in this company's history. So it's not just 2020. Like this the issue that we're going to talk about kind of rears up every sort of 5 to 10 years with this one. But the model, of course, is that Freehold essentially controls the lands that oil companies use to drill on. So an oil company shows up and they say, hey, we want to drill on your land. Freehold says, no problem. We're going to charge you this amount of money. And on a per barrel basis. And so what happens is that when the price of oil is higher, Freehold gets more money. And when the price of oil is lower, one of two things happens. Either Freehold gets less money or the producer says, hey, it's not economical to drill anymore. We're not going to do it. And so both of those things are quite bad for Freehold's dividend. So you look back at the history, what they typically do is the payout ratio gets quite high in terms of earnings. I don't know exactly what it is right now, but it's typically in that 80 to 90% range, which means that if oil falls and stays down, eventually Freehold has to cut the dividend.
Yeah.
And it's just a reality of that business. And it's a reality of them paying out so much of their earnings as that dividend. So as long as I think you're okay with that, and as long as you're looking at, okay, I'm going to buy this thing when it's low, maybe like right after they've cut the dividend, that's probably the best time to buy. But it's just a counter cyclical way to play it. You just buy when oil is down, and then you sell when oil is up, which for guys like me and you, Mike, who like to hold our shares for a long time, multiple years, forever, ideally, that's not an ideal situation for us.
Yeah, it requires a little bit more monitoring. And one thing I want to highlight here, as you mentioned, is if you go way back, you have a better understanding how this type of business model and this type of company will evolve over time. Meaning that a lot of investors will look at the past 5 years and say, okay, so I have like a good picture. And I love to focus on the past 5 years because it's closer to reality. But when you want to see the full cycle of a business, you need to go back way more. Not to say, oh, what happened in like 2008 or 2012, but more like understanding when the oil price goes up and down, you see the cycle over a long period of time, and then you see, okay, so the dividend is not safe at all. So it's really a game of buying low, selling high, and trying to move that way. The second one I want to highlight here is Topaz Energy, because it has been around only to it started at the end of 2020. So it shows a more, I don't know, like a better dividend triangle per my analysis. So stronger dividend, stronger revenue growth, stronger earnings per share growth, and of course a constant dividend increase as opposed to Freehold. So they still increase their dividend in 2025, but we can see the slowdown already. So I'm wondering if Topaz will eventually. This one is a little bit different, though. It's a kind of like a hybrid. It's not just a play on royalties. They have like long-term contract on midstream and water infrastructure as well. So it's not exactly the same type of play, but just want to see the fact that revenue and earnings are slowing down, the dividend growth is slowing down as well. It may become at one point another Freehold down the road, just because we only have like those about 5 years flush of information on it. Well, if we would have like 10 and 15, probably that we're going to end up to the same conclusion. I don't know if you agree with me on this one.
Yeah, I disagree a little bit on that one. And I own Topaz. Actually, this is one I
Cool.
recently bought. And we talked a couple weeks ago about how I'm not really a big fan of oil and gas. So I'll kind of go through the logic here a little bit. So Topaz is primarily a natural gas play. They have in the kind of the northwest Alberta, northeast BC corridor. It's this big natural gas area. It's about 4 hours away from my house. I've been out in the area before. So, not that I'm an oil and gas expert by any means, but it's like I've recognized that this is the area when it comes to natural gas. And natural gas consumption in Canada should increase slowly over time as power plants get converted and as we use natural gas as a primary fuel rather than oil on some things. But the big growth avenue is LNG exports to Asia. Of course, you have
Mhm.
LNG Canada. Prime Minister Mark Carney, his government just approved another LNG project in BC. And so the LNG that gets exported to Asia comes from that area. So Topaz owns those royalties, which means Tourmaline, which is the largest natural gas producer, and Topaz's partner, Tourmaline and other insiders own about 25% of Topaz. It's essentially a bet on LNG. And my sort of philosophy on it is that the demand from LNG from Asia looks good over the next sort of 10 to 20 years as they transition away from coal and oil and things like that. So I like the long-term growth there, and Topaz is the lowest risk way that I could get exposure to it. Because when you're buying Tourmaline, the natural gas producer, you are at the whims of the natural gas price. Topaz, you are as well, but it's less risky than owning the producer. And in terms of the dividend payout ratio, I think it's about 65% of free cash flow, which is a little high. But I think that with the growth of new production that's going to end up being exported, I think the dividend is safe and will grow over time. But Mike, you're probably right. The rate of increase will probably sort of settle into that 3 to 5% range rather than the 7 to 10% range that we
Yeah.
saw in the first few years of it being publicly traded.
I really like your thesis about the play on demand growth, though, like in the future. So we can see that there's a slowdown, like almost like a stagnation since 2023 in terms of like revenue and earnings. But thinking about those projects usually take a lot of time, eventually that could ramp up the demand, and then Topaz is definitely a like well placed to benefit from higher demand. And maybe we're gonna have like a pipeline going across Quebec one day, so we could sell natural gas to Europe. But anyway, that's another debate. We'll see how it goes on that side. Now we're gonna move on to the like metals. When we think about metals, most of the time we think about gold, but I want to do a quick introduction about another one that is interesting before we move to Franco Nevada, and this one is Labrador iron ore, LIF.TO. That is a pure play on iron ore, so they are making a 7% gross overriding royalty on it, plus 10 cents per ton commission. So whenever they sell iron, they just make money. And what is really interesting about this one, I think, and how when you look at the dividend triangle, is you see that the dividend goes up and down all the time. So you may be thinking it's completely absurd, it's not stable, and actually the dividend is not stable at all. It's really going up and down. So it's not about a dividend cut, because Labrador Iron Ore will pay a variable dividend. So what they do, and it's really smart as a streamer, because as we explained, whenever the commodity price goes down, the streamer is kind of stuck with their dividend payment if they decided to be to maintain it quarter over quarter, while Labrador Iron Ore gets that flexibility. And of course, if you look at the triangle right now, you'll see the revenue and the earnings are going down because the price of iron ore is not exactly growing these days. So as it goes down, you'll see that the dividend goes down accordingly. So it's really a play on iron. So a play on infrastructure, a play on construction for the long run. But whenever the demand goes down, that is definitely a problem. So this one could be interesting if you are looking to boost your dividend yield in your portfolio, but you know that you're not going to base your grocery budget on this one.
Yeah, the like you mentioned the risk on this one, which is of course that iron ore goes down, the dividend goes down. But I want to highlight the upside on that because this is one that I've owned for I think about 7 or 8 years now. It's and your thought process talking about that was exactly my thought process when I bought it. I knew that the dividend was not going to steadily march higher over time, but I didn't care because the payout was so high. So in 2022, I believe, or 2023, one of those years, it paid a $6 a share dividend. And right now, the stock, I think, trades for about $28 a share. So when iron ore is humming, the dividend is excellent. And of course, when iron ore is struggling, it's not. So you do get that upside if you do own it for a long time. The other thing I'll mention about this one is the mine that they have the royalty on. Now, take this with a grain of salt. I'm not a mining expert, but I think it's the best iron ore mine in the world. The grade of the iron ore is
Yeah.
excellent. The supply, there's like something like 30 to 35 years worth of supply left, and that's not even, looking at there's other kind of sites nearby they can expand into there. So you've got that going for you. And I mean, Mike, the place where the mine is, it's called Iron Ore. Oh no, it's Labrador City is famous for iron ore. Like you look
Yeah.
at the world of iron ore, and it's like Labrador City. That's where the best iron ore is. It's known as like an iron ore city. So I like that. I want to own that mine, and if I can get a generous dividend for doing so, all the better.
Yeah, and this one could be quite interesting to dig further. And of course, we're not providing financial advice here, but we mentioned the play on those streamers use it most of the time is you buy them or you look for them when commodity prices are low, which is exactly the case right now. So it screams like, oh, maybe you should dig a little bit into this one, understand, of course, the how it works, and as you mentioned, like very high quality iron pellets there. So when you're looking for to make steel and to build important infrastructure, this is also going to be an interesting play. But again, I mean, comes with risks. Do not expect that dividend to be stable, and of course the mine will eventually run out of iron, but we might not even see that day. So maybe it's going to be later down the road. So not to worry too much about this one at this point. So we are running a bit out of time, so I just want to quickly mention within precious metals, not because I like it, not because I have it in my portfolio, far from it, but I mean, when I look at the growth on this one is very strong. The ticker is WPM, trades on both US and Canadian market. Another one that is focusing on the purchase of metals. And when you look at the dividend triangle, the revenue, the earnings, the dividend is growing. So that one could be on your list. But I would like to spend a little bit more time on Franco Nevada because we both own this one. And also the fact that it's kind of ironic. I never thought of buying a play on gold until recently. It's not a huge portion of my portfolio either. But when I look at Franco Nevada for several years, what I see is stability. Like this business has been a rare company in the gold industry where the dividend keeps on increasing, never goes down, which is already a big plus for more than 10 years. And there is a lot of stability in the revenue and the earnings because of their model. Another thing that I really like is they have absolutely zero debt. So it gives them a lot of flexibility as well. And it came to my attention when they ran into problems with the government of Panama. Actually, it's still under problems right now. So the government of Panama closed one of their biggest mine, their Cobre Panama mine. And of course, that took a big hit in revenue and on earnings. When you look at revenue, it's not that bad because at the same time, there was a gold rush. So as gold price went up, the Franco Nevada was able to compensate a good part of this revenue, like lack of revenue coming from that mine from other mines. And over the past 2 years, the stock price is on fire. So I bought it around that time. I was a little bit late because I was not super enthusiastic about a play on gold, but I was looking at everything. Like, you have like high inflation, we had like tariffs mentioned all over the place, a lot of uncertainty. The market is at a like all-time high for, I mean, every week for the past like 3 years now. So I thought, well, it sounds like gold is going to continue to pump a little bit higher. And I did not want to buy gold, but I thought Franco Nevada still matches my strategy focusing on dividend growers. It has a very strong dividend triangle. So I thought, well, that's probably a good bet for me. And here I am with Franco Nevada in my portfolio for about a year now. I cannot say that I'm disappointed, actually. So I don't know, when did you buy it on your side, Nelson? And did you share? Do you share the same thesis here?
I bought in December 2023, right, very, very close to the lows. I got lucky there.
Nice.
My thesis is even more simple than your thesis, Mike. I have, you talked about the case for gold. I had no idea whether gold was going to go up or not, and it's not something I spend a lot of time thinking about because I am well aware that I'm not going to get that right on a consistent basis. It's like a coin flip. Like I don't think anybody really has that ability. If I did, I'd be a lot richer than what I am. But I,
For sure.
you know, like I'll say that the advantage to Franco Nevada really came out in this whole Panama situation that you summarized is that they're so diversified that
Mhm.
their largest streaming deal went to zero essentially, and it should come back at some point, but it essentially went to zero. And in 2026, the company will do record revenue again. Like it was a stumble, and that was it because they're so diversified. The thing I like about going back to Labrador iron ore for a minute is that mine is located in Canada, and we know that there's some security there because you have the government behind us. Where in Panama, you don't have as much security,
Mhm.
and so Franco Nevada, like they're smart, they realize that, and they've diversified into mines all across the world there. So that minimizes your risk as well. So you get that like little bit more diversification there. That and as you mentioned, dividend growth. The streamers are the only gold companies in the world that I could find that are committed to dividend growth. It's just committed to dividends in general. Gold gold miners, Mike, like all they do, they just want to like mine for gold. Like that's their whole shtick. They just like, hey, we got some money. Let's go like open up another gold mine. And it's like, okay, well, I don't want that. And so the streamers realize that, their shareholders want dividends and their shareholders want that, like we talked about earlier, that exposure to gold without the huge exposure to gold.
Yeah, so to close that show, I would highlight the fact that if you go for streamers, you're going to have less exposure to the upside. I mean, if there's a gold rush, of course, the gold miners are going to make a lot more money, and those stock price will skyrocket a lot faster. But on the other side, you have also a lot less downside, which is definitely good. And as you mentioned, they are the only type of business model in this industry that is really committed to pay a dividend that is stable at least and look to increase it over time. So we have mentioned a few companies here today with Topaz, with Wheathon Precious Metals, Franco Nevada, Frehold Royalties. I encourage you to do it at Labrador Iron Ore. I encourage you to do a deeper dive looking at the numbers, understanding the business model, and seek for diversification. I think that's the key because, of course, when you're dependent on commodity prices, you need to have other mechanism to protect your business model. And Franco Nevada has definitely proven that their management team, they know exactly what they're doing in that sense, because they absolutely had no control over what governments are going to decide, but they do have control on the assets they own, and they make sure that they get those contracts across the world. So, all right, Moose, that's enough for today. Thank you so much, Nelson, for your participation on this one. Do not forget to check out his newsletter at Canadian Dividend Investing. Tomorrow, we're going to talk again. And until then, don't forget to stay invested.